Hello friends, welcome to Combrella YouTube channel. My name is Karthik and in today's video, I will be discussing about what should be our investment strategy when the stock market is increasing. So friends, this topic is important especially in today's scenario because right now we are in the middle of a bull market. So if you see the stock market is continuously increasing for the last 1 year. So right from March 2020 when the stock market crashed and to now, which is April 2021, the stock market is continuously increasing. Sensex has touched 50,000 points also. So this video is important as to what should be our investment strategy. And a lot of people have this doubt in the mind as to what we should be doing now when the stock market is increasing, whether we should buy the shares now or we should hold and wait for the market to come down and then buy. So this is the question which a lot of people have. So I will explain you with the help of an example with all the numbers and with all the calculation in the form of a table, what should be our investment and how we can make profits when the stock markets are also increasing. And also I will explain with the help of a live example of Reliance shares and how if we apply this strategy while investing in Reliance shares, how we can make profits. So let's now dive into this video. Normally we have this assumption that we should do average of our share price only when the share market comes down or when the share price comes below our cost price. But that is not the only case, my dear friends. But even when the share price is increasing, when the stock market is increasing, that time also we should continuously keep buying shares regularly, periodically, and by doing that we can still make profits. When the share price goes down, yes, that time we should buy. But when share markets are increasing, that time also we should keep buying continuously. Okay, so let me just give you a small example. Say you bought shares of say ABC Limited at 500 rupees and 10 shares you bought. So 5,000 rupees you invested and you have kept aside some more money for investing into this company. Now after 500 rupees you bought, after some say 10 days or 1 week, the share price increased to 520. And then after that, after a few more days or 1 or 2 weeks, it increased to 540. Now what happens when the price touches 540 is people wait for the price to come back again to 500 and or less than 500 and then only they buy more shares. Okay, but that is not the right strategy. Even when the share price is increasing, that time also you should continuously buy. So say assuming after some more time, say another 1 or 2 weeks, the share price goes 560 and then slowly after a period of 3 months totally from 500 it reaches to 600 in a matter of say 3 or 4 months. Now if you don't buy the shares, then you have lost this investment opportunity. Once it has touched 600 rupees, it is very difficult for the price to again come back to 500 because it has to come down by 100 rupees, somewhere around 17-18%, which is very difficult unless there is some bad news in the market. So hence the strategy is we should continuously invest in the shares even when the price is increasing. And now I will show you with the help of a proper example in a table as to how even if we continuously buy shares when the prices are increasing, we can make profits. So friends, if you see this table, in this we are at the first month and if the share price of the company is 100 rupees and if you purchase 50 quantities and your total investment is 5,000 rupees. So your average cost is 100, market value is also 5,000 rupees. So like this, over a period of 12 months, if you continuously invest 5,000 rupees regularly every month on month or every week, whatever you can take. Say when you invest continuously some money, say 5,000 rupees over a period of time, how you can make profits, let us look at here. So first month you have purchased for 100 rupees. Now in the second month, the share price is now say 110 rupees. So you will be able to purchase 45 shares. Totally you will have 50 plus 45, 95 shares. Total cost is 10,000 and average cost is 10,000 by 95. So 105 and the market price is 110. So you are making 5 rupees profit per share in this situation. Like this, when the price increases to 120, 130, 140, at that time also, if you see, your average cost is 118. So when the market price is 140, your average cost is only 118. So still you are making 22 rupees profit per share. So this is how, even when the stock market is increasing, if you keep purchasing continuously, even when the price is increasing, you can still make profits. You will be still in the profitable situation only when you buy shares, even when the prices are increasing. Okay. Now let us take after 5th month, the share price drops. Okay, the share starts falling and it has come to 130 rupees. Okay, and that time your cost is 120, you are 10 rupees in a profit situation, and 7th month profit share price 120, your average cost also 120, no profit, no loss. Next month, so after 8th month, share price is 110, your cost is 119, so you are making 9 rupees loss per share. Now if the stock market continuously falls, you will make losses, but understand that it is not permanent, because if the stock market is falling, after some point of time it has to go up. The stock market will go up after it has gone down. And also when the share prices is falling down, that time it is good opportunity to buy more shares, because for 5,000 rupees you can buy more shares when the prices are coming down. So now let's see, after the 8th month, when the share prices starts to increase. So now the 9th month, if you see, when the share price is 120, your cost is 119, you start making 1 rupee profit per share. Then 10th month share price goes to 130, your cost is 120 and you are making 10 rupees profit. Then 140, 150, at 12th month you still have 27 rupees profit per share. So with this example, I hope you understand that even when the stock market is continuously increasing, like how we saw in the first 5 months, you will still have profit, you will be in the profit situation. When the stock market goes down, that time it is a good time to accumulate more money. And after, when the stock market goes down, it has to come up. When it goes up, again you will be in profitable situation. The important thing is you have to keep investing when the stock market is going up, that time also, and when the stock market is going down also. So a lot of people have this notion in the mind that they should invest when the stock market is going down, but that is not the situation, as you would have understood from this example. When the prices are increasing, that time also you were making profits only. Okay, so this is the fundamental logic of SIP, my dear friends, which is systematic investment plan, wherein you invest every week or every month in shares or mutual funds some amount constantly, because it is very difficult to time the market. Nobody, even the greatest of the people, cannot know when the market will go up, what is the highest price, when the market will fall, what is the lowest price. It is very difficult to predict how the market will perform. Hence, even when the share price is increasing, you should keep purchasing. Now, supposing in this situation, if you had waited, say in the first month, when you saw the share price is 100, and after that you wanted to invest more, say 50,000, 60,000 rupees you have invested in 12 months, you had kept aside this money and you were waiting for price to come back to 100 rupees, and then only you will invest more amount of money. But if you see in this situation, the share price has never come back to 100 again. From 100 it went to 140, then again it came to 110, then again it started increasing and went to 150. So if you were waiting for price to come down to 100 and then only buy, then that is a wrong strategy, and you would have lost this investment opportunity of investing 60,000 rupees. Okay, so I hope you understand from this table, and this table gives you a lot of clarity as to what you should do when the stock market is increasing. And also the underlying assumption in this example is that you want to invest for a longer period of time, say 5 years, 7 years and 10 years. Okay, and it is a good company which you are investing. You have done research and analyzed this company, and it is a good company, and the share price you expect to continuously increase over a period of time. So, and there are a lot of companies like this, say Reliance, Infosys, TCS, HDFC Bank, Asian Paints. All these are good companies whose share price continuously keeps increasing over a period of time. And also you have kept aside money for investment purposes, separately for investing. So these are the underlying assumptions based on which this example is working. Now let me tell you, with the help of a live example of Reliance shares, how this strategy will work in that particular situation. Say let us rewind 1 year back, when the stock market crashed in March 24th, 25th of March 2020. Okay, when the stock market crashed, and at that time the shares of Reliance also crashed, and it was around 1000 rupees at that particular time. And after that, as and when Reliance kept announcing deals with Facebook, Google, Microsoft, the share price continuously increased. From 1000 it went to 1200, 1400, 600, and then it reached even 2000 rupees, and now it is somewhere around 2000 rupees. Now, assuming if you had purchased shares of Reliance at that particular time in March when it was 1000 rupees, and 10 shares you purchased, so 10,000 rupees you have invested that time. After that, and you had kept aside some 50,000 rupees for investing into Reliance, and after that, when the stock market started going up, when the Reliance shares went up, you did not buy more shares and waited for share price to come down to 1000 and then only buy. Okay, as that is, when the share price went to 1200, you did not buy, you were waiting for price to again come down to 2000 rupees. and then after 2200 it went to 1400, 600, like that. So if you did that, then you would have lost an investment opportunity of investing into Reliance company shares, because after 1000 rupees it only went up and touched 2000 rupees and it never came back to 1000 rupees. Okay, and right now it is, which is at 2000 rupees, it is very difficult for it to come back to again 1000, which means it has to come down by 50%, which is very difficult unless something drastically or some bad news like COVID happens in the market, only then it will come down, and which is very rare. So at that time, if you had invested in Reliance at every stage from 1000 to 1200, 1400, 800 and 2000, you would still be in the profit situation only. And you saw in the table which I showed you how you will be in the profit situation only. So the conclusion is that even when the stock market is increasing, you should keep investing in piecemeal basis and not wait for the market to come down and then only invest. Okay, so like this, there are a lot of other strategies also in the stock market, my dear friends, which also I will be sharing in the future videos. And let me know in the comment section whether you understood this strategy or not, and any other comments about this video or any other videos, or in general also, if you have any comments, do let me know in the comment section. And if you like this video, please do share it in your circles, and also support me by subscribing to this channel, because it gives a lot of boost and confidence for making more videos in the future. Thanks for watching this. See you all in the next video. Namaste.